Well, it looks like the Federal Reserve is losing control of the credit markets. You may have seen a couple headlines this week about the repo rate, and the repo rate is something that's kind of hard to explain, and you really don't need to know what it is that much. But basically, it has to do with interbank lending and how banks, in order to keep up and gain their operating costs that they need to keep their business going and not go bankrupt, they have to take out really short-term loans from other banks. And this is a way that banks make money because sometimes if you're a bank, you'll have more cash than you need to keep your business going, and at other times you'll have less cash than you need, and these things kind of fluctuate. So banks that have enough cash in their reserves, more than they need, loan it out overnight, literally, to other banks for a fee. And this is just an extra way that they make money. However, and so if this goes on at a normal pace, you would expect that the repo rate, which is what they call it, it's the rate that these banks pay for this service of having these overnight loans, that should stay about the same. If you've got the same ratio of banks that have enough money versus banks that have a little too that don't have enough money, that have to borrow overnight. But what's happened on Monday and really throughout this whole week is that the repo rate has spiked, and that means that now all of a sudden there are more banks that really are short of cash relative to banks that that have enough cash to keep the doors open. At least that's how I understand this. I might be wrong because, again, like most people, I really didn't know much about what the repo rate was before this week, so I've been trying to learn at least a bit about it. But I at least understand overnight lending and why that happens. So I think I've parsed that together pretty well. And so if you're seeing a spike in the repo rate, that means that banks generally are a little more short of cash than they have been over the last 10, 12 years. And that's why the Federal Reserve has had to intervene now 3 days in a row and conduct what they call repo operations, which is where the Fed essentially injects a few $1 billion into the repo markets to try and account for all these banks that are short of cash to make sure that the rate doesn't rise, because the Fed wants to keep the repo rate about 2%. But they've been failing to do that, and of course, the repo market, credit markets in general, aren't very healthy if they operate constantly on the Fed having to inject liquidity to keep rates low, because the market here is trying to force rates higher because it's sending a signal that, hey, banks are short of cash. And in a normal free market economy, the likes of which only really has existed in theory, we haven't really seen a relatively free banking system in any of our lifetimes. Certainly since well before World War I. But in a normal free banking sector, these rising rates would encourage people to deposit more money into the banks, and then the banks would be, flush with cash, and that would solve the problem by itself. Or alternatively, the banks that are, short of cash and can't keep their doors open would fold and go bankrupt, just like they should. But what the Fed is doing essentially is they're helping these banks not go bankrupt. The Fed has just conducted a stealth bailout for 3 days in a row. They have saved banks from going under, because had this continued, had the Fed not done anything, the repo rate would have spiked, and it would have gone higher, and it probably would have gone higher and higher, and eventually what you would have started seeing is things starting to break, meaning that the least fiscally sound banks, the banks that are in the most trouble, would start going under. And then of course we'd have another financial crisis on our hands. However, in a normal unobstructed economy, repo rates, or whatever the equivalent would be in a free market, would be able to fluctuate pretty frequently as these the interplay between supply and demand works itself out. And you wouldn't have banks that are as vulnerable to going under if the repo rate spikes, because you would have banks that are naturally going to be much more fiscally responsible and more conservative with their cash, because they know that it actually is possible for them to go under. What the Fed has done by continually bailing out banks, is not just the Fed, but central banks in general. The central banks exist to bail out banks. If you're not too familiar with how banking works, that's what a central bank is. The central bank was created to make sure that the banks don't go bust, that the bankers always are able to keep the doors open, and that really they can't lose. And so this incentivizes, bad behavior, bad business decisions on the part of banks, because they know that they've got that cushion under them of the Fed. Super Powell will come in with his red cape and save the day. But as it turns out, Powell is not Superman, and the Fed is not the Justice League. They can't always save the day. And we're seeing that this week, because the Fed is trying to get the repo rate back down to 2%, and they're failing. They're not injecting enough money. And even if they did inject enough money, as soon as they stopped injecting that money, well, then the rate would go right back up, because the fact of the matter is that the banks are short of cash. You see, the U.S. economy works a lot like a Ponzi scheme. And a Ponzi scheme, the way that the thing keeps going, the way that people keep getting their results, is that new people keep coming in to put new money and inject new money into the system as people are pulling money out of, pulling out of it at the other end. That's kind of, there's nothing really being produced. You're borrowing, or rather, you're stealing money from Peter to pay Paul. That's how a Ponzi scheme works. Well, it's the same is true here in the U.S. economy, except here you have the Fed is the one constantly injecting new money into your Ponzi scheme because they have a printing press and they can do that forever. Well, even this great power has risks to it, namely inflation, which we haven't seen yet. And it's not like we're at the point to where there's declining confidence in the dollar by any means. So we're not to that stage yet. But the Fed is certainly they don't have a blank check, as it were. They actually, literally they do have a blank check, but figuratively they do not have a blank check. If the repo rate really is going up for natural reasons, and the banks really are short of cash, well, then the Fed injecting cash is not going to it's not going to fix their practices. They're not really going to put out the fire, as they like to think of it. What they're really doing is they're pouring more gasoline onto the fire. But it just looks, because gasoline is in liquid form until it evaporates, it does look at first like they're putting out the fire, because there's all that liquid that is smothering the fire. But as soon as that gasoline evaporates, as soon as that new Fed money makes its way into the system, it gets put to the same bad uses as the money that the Fed was trying to replace. The Fed is, by throwing good money after bad, is not going to reap positive results. The monster is only going to get worse, and the banking sector is going to require more and more stimulus to stay afloat. That's why Powell has announced pretty much that there's going to be QE4, or rather QE forever. Because after 1, 2, and 3 rounds of quantitative easing under Ben Bernanke and Janet Yellen, the market really has grown accustomed to that direct shot in the arm of adrenaline from the Fed. And we're seeing that rate cuts really are not cutting it enough. The market needs, market in quotes, needs an ever greater and greater dose of its monetary heroin in order to achieve the same high. So we'll see how long the Fed can keep things going right now, as far as what appears to be the beginning of the unwind of this current financial bubble that they've blown. Because Powell has made it abundantly clear that he's going to do everything in his power to sustain the expansion. And by sustain the expansion, of course, he means try and stave off the crash. The crash that he knows is inevitable in the wake of every Fed-induced bubble. So if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.